Hello everyone. Now let's continue our discussion for chapter 12 and we'll talk about dividends. So what are dividends? Dividends is basically the distribution of net income to the shareholders. And it could be the common stockholders and the preferred shareholders. And as we said in the previous video, preferred shareholders typically they receive the dividends before the common stockholders. Companies are not required to pay dividends every year. If they decide they're not going to pay dividends for a specific year, then they owe the preferred stockholders some of these dividends or all the dividends that were not paid for that current year until actually they pay or declare dividends to everybody. Again, this is under the condition that the preferred stock is cumulative preferred stock. So when a board of directors declares a cash dividends, it authorizes or it allows the distribution of cash to stockholders. So when a board of directors declares a stock dividends, it authorizes the distribution of stock. So it's not always cash dividends. Sometimes it can be a distribution of stock dividends. I always find stock dividends to be a little bit tricky because they're actually paying shareholders additional shares. And in reality, this is, I don't want to say, but deceiving or fooling the shareholders. But in some form, it's an easy way for a company or for companies to issue dividends without actually paying any asset. And when they issue stock dividends, they actually dilute the dividends. But anyway, this is, I think, beyond the interest of our discussion here. I think the focus here is to see how the accounting treatment for cash dividends versus stock dividends or any other form of dividends. So in both cases, declaration or declaring a dividend reduces the retained earnings of the corporation. So let's start with the cash dividends. And I think it's simple, it's easy, it's very logical. A cash distribution of earnings by a corporation to its shareholders is a cash dividend. So when the company or the corporation decides to pay dividends or distribute cash to the shareholders, that's what we call it, cash distribution or cash dividends. So although dividends may be paid in other assets, cash dividends are the most common. Three conditions for a cash dividends should be met. The first one, there should be sufficient retained earnings. The second one is sufficient cash, because of course it doesn't make sense to borrow money to pay dividends. And then finally, formal action by the board of directors. In other words, the board of directors of the corporation should approve the declaration of dividends. There must be sufficient large enough balance in retained earnings to declare cash dividends. What if we don't have enough retained earnings? Then it's not appropriate to declare dividends, because otherwise you'll end up having negative retained earnings. And if you think about it, retained earnings is the amount of net income that has been retained with the business. So it doesn't make sense to distribute dividends that's more than what you retain in net income. So even if there are sufficient retained earnings and cash, a corporation's board of directors, sometimes they don't pay dividends because they're not required to. Sometimes they feel it's better to keep the dividends for a while because they're expecting growth, they have long-term projects. Many corporations that are growing, they sometimes decide not to pay dividends. So special or extra dividends may also be paid when a corporation experiences higher than normal profit. And sometimes if the company feels they want to impress the shareholders, they had a good year, they had a lot of net income they didn't expect, so in this case they might pay an extra dividends. 3 dates should be remembered. These dates include the date of declaration, the date of record, and date of payment. So what is the date of declaration? The date of declaration is the date the board of directors formally authorizes the payment of the dividends. And that's very important because that's the date where we decide we're going to pay the dividends. At that date, the corporation creates a liability because once they say we have to pay this amount, then this is an important date. And another important date, but it's not very critical for journal entries, but it's important to know who's going to receive the dividends, is the date of record, which is the date the corporation uses to determine which stockholders would receive the dividends. So for accounting records, or in other words, like for journal entries, that's not too critical for us. But date of declaration is critical. The other important date is the date of payment. it's the date the corporation would pay the dividends to the stockholders who own the stock on the date of record. So that's very critical because that's a date where we're going to see the cash going out, and we expect to see cash on the credit side. So let's see an example. Assume that on October 1st, Hibbert Corporation declares the following cash dividends with a date of record of November 10th and a date of payment of December 2nd. So preferred stock, $100 par, 5,000 shares outstanding, and the dividends per share is $2.50, and the total dividends in this case would be $12,500. For the common stock, it's $10 par, 100,000 shares outstanding. They pay 30 cents per share for a total of 30,000 for the common stockholders. The total of the 30 and the 12,500 is 42,500. So how are we going to record this? On the date of declaration, we are creating the liability. So we credit, and I'm starting with a credit, which is not a normal thing, but I'm always starting with the easy thing to remember. So we're creating this liability. We credit cash dividends payable, and that's a liability account for the total value that we owe our shareholders. And then on the debit, we have the dividends account. But because it's cash dividends, we call it cash dividends. So to be more specific, so we debit cash dividends, and remember, dividends starts with a D. Whenever they're increasing, we debit them, and then we credit cash dividends payable. On November 10th, which is the date of record, no entry is necessary. The date merely determines which stockholders will receive the dividends. So as I said before, for journal entries purposes, that's not very critical. But the date of payment is. So on the date of payment, which is December 2nd, the company is going to record the following journal entry. We're going to get rid of our liability account by debiting the liability. And remember, when we debit the liability, we're reducing it. So we debit cash dividends payable, and we credit cash for $42,500. When we credit cash, we're making the payment. So at the end of the accounting period, the balance in cash dividends would be transferred to retained earnings as part of the closing process, which is something that we'll discuss later. So a stock dividends, on the other side, is whenever the company distributes dividends in the form of stock. So a stock distribution of shares is a distribution of shares of stock to stockholders. Stock dividends are normally declared only on common stock and issued to common stockholders. We rarely see, actually we don't ever see it like stock dividends for preferred stockholders. So stock dividends affect only stockholders' equity. Specifically, the amount of the stock dividends is transferred from retained earnings to paid-in capital. The amount transferred is normally the fair value or the market price of the shares issued in the stock dividends. So let's see an example. Assume that the stockholders' equity account of Hendricks Corporation is, as of December 15, are as follows. So we have common stock for $20 par. We have 2 million shares issued, so the total is 40 million. We have an excess or paid-in capital in excess of par. Sometimes, by the way, they call it additional paid-in capital in excess of par. So it's 9 million. And then we have retained earnings of 26.6 million. So on December 15th, Hendricks Corporation declares a stock dividends of 5% or 100,000 shares, which is calculated as 2 million multiplied by 5%. So remember, we have 2 million shares of common stock. So 2 million multiplied by 5% to be issued on January 10th to stockholders of record on December 31st. So the market price of the stock on December 15th, which is the date of declaration, is $31 per share. So on December 15th, we're going to record the following journal entry. So we're going to start again with the credit side. That's always easy for me. So we're going to start with the stock dividends, and the stock dividends distributable here, which is similar to payable. But this is stock, so we're going to use stock dividend distributable. It's not cash. If it's cash, we say cash payable. And it's 2 million. How we got the 2 million? It's the 100,000 shares multiplied by the par value, which is $20. As you can see in the previous slide here, it's $20. So we take the 2 million shares multiplied by 5%. That gave us 100,000. 100,000 multiplied by $20, and it's 2 million. But the market price is 31. So that would be paid-in capital in excess of par for common stock, which is again the 100,000 multiplied by 11, which is the difference between the $20 par value and the 31 market price. So that's 1.1 million. The total of this is going to be the stock dividends, which is 3.1 million on the debit side. Remember, in the previous example we call it cash dividends. In this example we're going to call it stock dividends, just to differentiate. But both of them are dividends which are going to reduce our retained earnings. So at the end of the period, the stock dividends distributable and paid in capital in excess of par for the common stock accounts are reported in the paid in capital section of the balance sheet. So on the payment date or the distribution date, which is January 10th, the stock dividends is distributed to stockholders by issuing 100,000 shares of common stock. The issuance of the stock is recorded by the following entry. We are going to remove the liability, so we're going to debit stock dividend distributable, and we credit common stock. The additional paid in capital has been already taken care of, or the paid in capital in excess of par has been already taken care of, so we don't need to worry about it. So in other words, we removed, or we got rid of the stock dividend distributable, and we issued the common stock. So stock dividends does not change the assets, liabilities, or stockholders' equity of a corporation. Because as I said before, we really don't pay any assets. We don't pay cash, we don't distribute inventory, anything like that. So we're just replaced some form of retained earnings with another equity, which is the dividends. So likewise, the stock dividends does not change an individual stockholder's proportionate interest or equity in the corporation. Your ratio is the same. And we'll see in the next slide how this would look like. So assume a stockholder owns 1,000 shares of a corporation, 10,000 shares outstanding, which is about 10% of the company. So if the corporation declares 6% stock dividends, the stockholders' proportionate interest would not change. So you see here, the company has a total of 10,000 shares. The number of shares owned by that specific shareholder is 1,000. So the proportional ownership is 10%. When the company issued the 6% stock dividends, the total number of shares now is 10,600. The specific shareholder now had 1,060, which is a 6% dividends on the 1,000 that he had before. So now he has 1,060. If you divide the 1,060 by 10,600, it's still the 10%. So that's why I feel like we are tricking a little bit the shareholders, because your ownership is still the same, but you have more shares with lower value. Another interesting thing for a corporation is something called stock split, and I'm sure you heard about stock splits, especially for the large corporations like Facebook, like all the big names. I think Microsoft went through stock split, Google, and all these big names. So stock split is a process by which a corporation reduces the par or stated value of its common stock and issues a proportionate number of additional shares. So why corporations do that? If you think about it, sometimes a stock might increase in value dramatically to the point that it becomes not very accessible or like affordable for small investors. So like Google, for example, it started with $20 and at some point it reached like $2,000. So a small investor who has maybe $1,000 and wants to invest in Google cannot do that anymore. So the companies sometimes they go through a stock split, and a stock split, they split each stock into maybe 2 or 3 or sometimes 5 shares. And by that way, if the stock value was, let's say, $1,000, will go down to 200. And as a shareholder, instead of owning only one stock, I would have 5. So it's increasing the number of stock and reducing its market value and its par value, of course. So a stock split applies to all common shares, including the unissued and issued shares. A major objective of a stock split is to reduce the market price per share of the stock to make it more affordable to small investors. So assume that Rojak Corporation has 10,000 shares of $100 par common stock outstanding with a current market price of $150 per share. The board of directors declares the following stock split. So each common share would receive 5 shares for each share held. So that's why we call it 5-for-1 stock split. Each share would be 5. So instead of the corporation having 10,000 shares, now it has 50 shares outstanding. So you can see here, we got the 10,000, which was originally issued by the company, multiplied by 5, and now we have 50,000. And of course, the par value, instead of being $100, now it's going to be 20 because we take the par value divided by 5. Very similar to like somebody who has a $100 bill, and to make it easier to spending, just break it down into 5 20s. It's the same thing. So we have 5 bills now. Each one is worth only 20 instead of 100. So the par value of common stock outstanding is 1 million, both before and after the stock split. Nothing changed. The number of shares were 10,000 multiplied by 100 for a total of 1 million. Now they're 50,000 multiplied by 20 for still 1 million. Nothing changed. So we don't need to do a journal entry, just a footnote that explains that. So each Rojak Corporation shareholder owns the same total par amount of stock before and after the stock split. And this is just something that would explain it. Like it's like a pie where we had, like, let's say before the split I had 4 shares, each one has $100 par value for a total of $400. Now I have 20 shares of 20 each, which is still $400 total par value. So let me stop here, and in the next video we're going to talk about something called treasury stock.